Hey there, everyone. Happy Friday, December 19th, 2025. Welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from a kind of chilly but not too wet Redmond, Washington. Hope you guys are all doing well. We had our first performance of the Honda Messiah with the Seattle Symphony last night. Awesome. I mean, what a feel-good piece to perform. If you're in the area, I hope you will check out our performances on Saturday or Sunday. But it was an enjoyable one. Soloists are good. I selfishly would tell you, I think the chorus is pretty awesome. Orchestra sounds good. Fun piece. Great way to kick off this holiday season. Hope you guys are all doing well wherever you're tuning in from, and I appreciate you following me and my work here in 2025. I wish you guys a very joyful and restful holiday season. But before we can do that, we have to wrap up this week here and talk about what happened in the market. So today's a mailbag episode. We're going to talk just briefly about the market conditions here on Friday. Just a quick check-in. I like to spend a little more time over the weekend after Friday's close to process some data, give some thought when the markets are closed, and then share those insights with my Market Misbehavior Premium members. So you should expect your next weekly flight plan over the weekend. But we will recap briefly the market conditions, and I've got 6 or 7 questions that I've grabbed for you. I'll try to go quickly through them because I tend to be a little long-winded here on the Friday mailbag episode, but I really enjoy the questions you guys have sent in. These are all questions I've received here in the last week in our mailbag. You can always drop questions at any time on our YouTube channel. Just use the comment section. Any question is fair game. We'll put those in the mailbag, and then every Friday I like to hand select some of those questions to answer for all of our benefit, I hope. All right, let's get to the markets and what happened. Not a bad day. Kind of a risk on, kind of nice upside follow through here day today. Yesterday was a choppy, sideways, sloppy kind of market. We talked about that kind of range bound environment, basically settling in around 67.75, 67.80. The question would be, how do we end the week? Do we end in a position of strength? The S&P did open higher and traded higher into the 1 p.m. Eastern timeframe. From there on, kind of held those gains from the morning. That's enough to put the S&P up 0.9%. 68.35 is the close. The NASDAQ Composite up above 23,300. That's up 1.3%. Mid caps and small caps all up, but large over small, growth over value was the story today. The VIX moving lower by almost 2 full points. That is a huge swing in the VIX, going down below 15. So we talked yesterday and earlier this week, volatility just starting to tick higher a little bit. Anything below 20 is okay. Anything above 20, we have to start to think a little bit more about it. Finish the week below 15. That's a low volatility environment according to the options market, right? That's the S&P 500 index options, and basically suggests we should be anticipating small moves in the major benchmarks, not huge ones. Bonds sold off a bit today, and so the rates generally moved higher. 10-year yields around 4.15, long bond yields above 4.8%, 5-year point right around 3.7%, dollar up just a little bit. Looking at the commodity space, I mean, silver just trying to reinforce its leadership spot as one of the top charts of 2025, if not the top chart, maybe competing with other precious metals for that. But 2.7%. I mean, silver's up over 130% for the year would be my guess about where it's at compared to the S&P, up about 18 to 20% maybe. Not bad relative returns there. Crude oil higher, copper higher. Good day for commodities generally. Cryptocurrencies continuing to sort of chop around just in the last 24 hours, kind of ticked down to just below 85,000. Earlier today, we got up to just around 89,000. Which appears to be sort of a short-term ceiling, sort of that 89 to 90,000 range. Currently sitting just above 88,000. Ether prices just below 3,000. All 10 of the top coins in the green here. Sector-wise, technology was the story today, up 2.2%. Nice finish to the week after some questionable price action on a lot of those charts here this week, but nice way to finish strong there on tech. Industrials up 0.9%. Healthcare up about 0.2%. Only 4 of the S&P sectors down. 3 of the 4 that were down fairly defensive. Utilities, consumer staples, and real estate were all down for the day, and energy was flat. consumer discretionary, though, which is a little more offensive and has been one of the better relative performers in December, actually going down today as well. It looks like that was enough to keep our short-term market trend model back to bullish on all time frames. I'll have to dig in the data over the weekend. Breadth was kind of neutral to slightly positive. In the S&P, 56% of those members were higher, so that's not bad. Nvidia and Broadcom having a nice bounce to finish the week. I mean, the weakness in the AI trade has been noticeable, I would say, here in the month of December, but nice strong finish with Nvidia and Broadcom both up over 3%. Alphabet also up 1.6%. Meta still struggling below Fibonacci resistance, down 0.9%. Tesla down about 0.5%. Amazon, Microsoft still testing that 200-day moving average, holding it for now. Overall, I mean, this is sort of a choppy week, sort of a V shape to this week, with Monday, Tuesday, and then Wednesday pushing lower. Thursday and Friday popping up here a bit higher. And, again, by Wednesday midday, I mean, Wednesday at the close, this looked like it could be one of the worst weeks in a long time. Thursday and certainly today's upside move sort of saving some of that. Ends up being a slight down week, but not nearly as bad as it's actually maybe technically an up week, right? I mean, if you look at where we were at last Friday, I mean, yeah, we were just up slightly for the week, which is crazy compared to where we were on a Wednesday. Offense over defense, the breadth is decent with the bullish percent index and the stocks above their 50-day moving average, both above 50%. Advanced decliners have been trending higher in the last month. Not bad action in the S&P, and a nice way to finish this week for sure. All right, we will dig into those themes a lot more for our Market Misbehavior Premium members. It is never too late and always an awesome time to become a premium member. I would suggest you can find more info at marketmisbehavior.com/premium. Make sure you use the code YouTube when you check out for 30% off your first 12 months on any plan. With that in mind, while our premium members can ask questions at all times in our member community, otherwise, we've got our mailbag here on our YouTube channel, and I've hand-selected some of the questions we received here to dig in a little bit deeper. Please keep the questions coming. And here's question number one. Is it true the next 2 weeks are window dressing and we shouldn't infer any biases for the remainder of the year? I mean, so like yes and no. I guess no, then technically, right? I mean, if I don't agree with all of that, I guess the answer would be no. But there is some truth to what you're saying, right? At the end of the year, there normally is that sort of window dressing kind of thing. Generally the December tends to be a positive month. We're certainly starting to see signs of that here with strength going into the weekend. Keep in mind the Santa Claus rally is something a little bit different. A lot of people have sort of turned the Santa Claus rally into generally anything in December is good. And, December's a strong month. That really wasn't what Yale Hirsch, who created this idea, really wasn't what he had in mind. What, he was talking about, and I would encourage you, by the way, to listen to one of the recent Market Misbehavior podcast interviews with Jeff Hirsch, editor of the Stock Traders Almanac, because I asked him about the Santa Claus rally and what he will tell you in that episode, but I will reiterate here today. The Santa Claus rally is a pattern that Yale Hirsch, Jeff's father, discovered years ago, which was looking at the last 5 trading days in December and the first 2 trading days in January. And the quote was, "If Santa Claus should fail to call, bears may come to Broaden Wall." That is a way of saying if that period, last 5 days of December, first 2 days in January, if those aren't strong, first quarter is probably going to be a lot weaker than you want. And so it's a way of sort of looking at that Santa Claus rally, which often happens as an indicator of what could happen in January. Jeff will tell you about how, in his opinion, that's one of a trifecta of indicators: the Santa Claus rally, the January effect, and the January barometer. And those are 3 different things to look for here over the next 6 weeks, really through the end of January, as a way of getting a sense of what the conditions are, setting the table for the year 2026. So I would say December tends to be a decent month at this point with today's rally. We're basically flat for the month. We're slightly higher now for the month of December. We're right at zero, to be honest with you, from where we were at the end of November. So still an open question as to how the rest of December will play out. I mean, generally, I would tend to think of December as a positive month. November and December are two of the strongest months going back on the seasonal calendar. And you often have some sort of general optimistic views going into the end of the year. January, and how often have we seen the market change dramatically from the end of one year to the beginning of the next? And I'll show you what comes to mind. I think that was, all right, I'm just completely butchering this chart to show you. I'm trying to remember what was that year I was thinking about, where we had a big shift right into, oh yeah, this is what I'm thinking. 2021, I'm still scarred from that. I mean, 2021 was just such a fantastic year. And it's like we flipped the calendar and things changed dramatically. Kind of the opposite happened at the end of 2022. We had this major pullback in December and then just turned on a dime in January. So that has happened before, where whatever's happening going into the year end, it completely shifts at the beginning of the new year. So what happened? And so I guess the point of that is, should I make any long-term conclusions based on what we see in December? I have learned no. December's kind of its thing. The new year, when everyone's back from the holidays, everyone right now, at least in my family, is thinking about the holidays, thinking about Christmas, thinking about New Year's, thinking about time off, coming back from school, all those kind of things. The new year is when we all sort of plug back into, okay, the holidays are over. Now let's focus on market conditions and what's going on here. So you're coming out of a quiet period, which is why January is often a big shift. And so would I draw any long-term conclusions from December? I probably would not. It's kind of an interesting, I mean, this has been such an unusual year in so many ways, but one thing to note is any economic data we can get our hands on is going to be pretty valuable. So while this is normally a quiet period, remember, we're also kind of still churning through the backlog of economic data. Some of the things like this week's inflation data came out pretty encouraging in that the inflation rate was well below expectations. But everything I have read and talking to some smart people suggests that it's kind of incomplete data, because it wasn't fully formed data set about inflation. So, in coming weeks and months, we will learn a better picture about jobs and inflation and those sorts of things. So that would be the only thing that could be kind of unusual here. But generally, yeah, I wouldn't draw any long-term conclusions from December is my summarization there. Next question. Hi, Dave. FANG, which is Diamondback Energy, was reviewed as a promising chart in late November. How would you rate the recent price action? Price has gone below the 21-day and 50-day moving average on December 18th. And you explained further in your question, would you fully exit if the price stays below the 50-day moving average or briefly goes below the 200-day, or would you reconsider holding longer? Yes, well, I mean, as always, right? Anything that I share on the show, it's not a recommendation. I don't take a lot of position on individual stocks, and that is a decision I made a long time ago when I worked for a number of firms where they made it really hard for compliance reasons to invest in individual stocks. So most of my portfolio is built on ETFs and different ways of playing that space, because I had a lot less restrictions on how we could trade ETFs in our own portfolios. So most of us developed personal portfolios that were built around ETFs and funds that were not subject to incredibly strict compliance rules on when we could buy or sell and what kind of positions we could take. And I found that, I was not allowed to do what the chart told me to do. So I focus on things that I could actually trade. And so after leaving those, and I don't have a compliance department anymore, but, again, I sort of developed my general investment process back then. And while I've tweaked it, it's still pretty close to where it was there. So, again, not a recommendation on FANG. I don't have a position in the stock. I did not take any position. I try to identify ideas and share them with you and others. And that's how I try to, be a part of the success story for investors. It's not by making the trades myself, but to encourage you and try to help inform you and educate you on how to find good securities for own portfolios. So I think what you're talking about is back here, right? We talked about the breakout. I remember this, right? I mean, FANG is a sideways chart finally breaking above the 200-day, finally breaking above resistance, clearing that like 150 level, which was pretty meaningful. That was a really good breakout. Now, from there, we've kind of broken back down to that level. So if we look, I think it's still sort of like okay, right? It's like, it's okay. And here's what I mean, right? Here's the resistance. Here's that basing pattern, right? So we're settling into this range between 135 and 150. And so when you have a chart that's in a sideways kind of consolidation phase, I think what you look for is a breakout. A breakout above the resistance is bullish. A breakdown below support is bearish. Here we can see at the end of November, a break above resistance. I think that's a bullish development on the chart. Went up for about a week. We have this big shooting star candle right about there, where the open and close are near the lows of the day. Big, long upper shadow. That's a short-term reversal candle, which would be one thing that definitely would have caught my eye if I did have a position on a chart like this. From there, that's been the peak, and we've rotated lower. Now, have we broken below this level of resistance? I mean, not by much. Are we sort of toying around with this level? We're holding the 50-day moving average. So I would say here it's a great chart. Here it's an okay chart. Below there, it's a not so okay chart. And below 135, it's a bad chart, right? It's a great chart. It's a good chart. It's an okay chart. It's a bad chart. And so we're in like we're right on the border between like good and okay. And a long way to go before it's a bad chart. But so for me, if I take a position here, I mean, we're right at the point where I would probably be, stopped out or maybe taking part of the position off. It's not enough of a breakdown to be a clear break of the support level that I've identified, but not great enough that I wouldn't be worried about it. I think it's right kind of at that point. So what you have to remember is from a technical perspective, buying breakouts like this generally can be a very profitable approach. There's no guarantee that it's always going to work. And so it's not just about finding breakouts and then going to find other breakouts. It's about finding breakouts, taking a position, and then using good money management skills. And the charts that continue to work, you stick with those. The charts that don't work, you get out of those, right? And that's goes back to Peter Lynch's way of describing it, was that's watering your flowers and pulling your weeds, right? The things that start working, you want to water those and nurture those and keep growing your portfolio with those positions. The charts that don't work, those are your weeds. You want to be pulling them out. So right now, I would say right on the border between good and okay. It gets to okay. I mean, that's where I'll probably be lightening up a position. It gets below 135. That for me is like a point of no return. It's just a bad chart, and I'd probably be looking for an opportunity elsewhere. That's how I would think of it. Next question. On October 17th, you stated the Hindenburg Omen triggered, but the unfolding could take a while to manifest. Very true. Where are we on the Hindenburg Omen timeline? What are the signs to look for? What a great question, and thank you. I've kind of revisited it off and on. I haven't talked a ton about it, but let me bring it up here, and I'll show you. So we go to the Hindenburg Omen chart, which is here. So, as a reminder, I don't want to spend too much time going through the details of the Hindenburg Omen. I've got videos on my YouTube channel here where I talk about this methodology, how it was created, what it means, what you look for. So if you want to understand more about this particular indicator, I would encourage you to look there. Here's the thing. A Hindenburg Omen is like such a hilariously polarizing thing. I mean, I hope you can tell I try not to take life too seriously. And so when people push back on the Hindenburg Omen is crap or it doesn't work, like, I just kind of move on to the next thing. It's just not worth getting into debate about it. And I would tell you that I think people often confuse things like the Hindenburg Omen with timing tools, right? It's not a great timing tool, right? So it's like here in November and December of 2024, the Hindenburg Omen had valid sell signals, right? That's what the indicator told you we are at or near a major top. Was that the top? Like, no, right? We made a higher high in January and a higher high in February. By the end, right, between the initial signal and where, the eventual top was, I mean, it's, I can't even see because it's such a small amount here. So let me zoom in a little bit. Like a year and a half. So the second Hindenburg Omen signal was right about here on this date. We're right here. We ended up going, oops, sorry, I'm butchering this whole thing. We ended up going 1.5%, 2% higher to the eventual peak in February right here, right? So from the initial moment that Hindenburg Omen was confirmed, it was about 2 months, and we gained another 2% before a major top. So was that a successful signal? In my opinion, 100% yes, because the Hindenburg Omen is not telling me, it's not like when that second thing pops, it's like, oh, we need to sell today. That's not how this indicator works. For me, the Hindenburg Omen is a leading indicator. This tells me, look, we are looking really similar to a bunch of other previous major market tops. What you now want to do is look for the signals that have often followed major market tops to say, yep, it's happening, right? So a lot of things happen after the Hindenburg Omen signals. If you look back through all the very successful signals that it's had, and you look through the unsuccessful signals where the market really didn't sell off, what differentiates those two, and I think helps you validate and identify when to follow these signals is it's what happens afterwards, right? It's not about just the Hindenburg Omen firing. That is a sign that we're in the late stage. It tells you we're in the 8th inning or the 9th inning. There's no guarantee that we don't go to extra innings. We end up going to like 12 or 13 innings before the game is over, but it tells you we're probably near the end of the game. So what we look for are the signs that the game is over. So for me, it's validating that Hindenburg Omen with other things, signals of breadth and momentum, looking for changes of character, changes in leadership, looking for breakdowns of lines in the sand. So what we talked about on this Hindenburg Omen example was, all right, Hindenburg Omen has fired. We're also seeing divergences. We're seeing breadth deteriorate. We're seeing a number of things. Here's what we would start to look for. We look for a break of the line in the sand. We look for a Dow theory sell signal. We look for all these other things that identify that we have had a major top. We haven't had those kind of lagging indicators really following through just yet, right? And in particular, the S&P 6550, that's like the level, right? That's the line in the sand that I've been reiterating here in the fourth quarter as an important level of support. And as long as we hold that, things aren't that bad. Now, there's plenty of wiggle room between 6550 and where we closed today, around 6820, 6830. And that's, I think, normal kind of market fluctuation. So, people will look at this example right here and insist that the Hindenburg Omen is useless because the market went higher. I just don't see that as the case. I see this as a fantastic early warning that we were at or near the highs. Told me probably not the time to be taking aggressive long positions because I don't need that last 2% as a price to pay for riding the market all the way down to the April low. I'd rather have those early. It's like a tornado siren. It's not telling you the tornado is crushing your house right now, but it's telling you the conditions are pretty ripe for a tornado to be coming down your street. So let's just go ahead and get in the basement and assume that that's a possibility. That's how I think of the Hindenburg Omen. It's a tornado siren. It's not a timing tool. And again, I people love to just critique on the Hindenburg Omen. A week later, it didn't go down. That was wrong. Those are people that I don't think have watched the discussion we've had where I actually explain, here's what it means. Here's how it fits into the process. People want simplicity, I think. So for the timeline, I think we're still very much like in this kind of phase where we still haven't even gotten above that October peak, right? So if you're all bulled up, we're still below where we were on Halloween, right? Right around that area. So I don't know how bullish that is, but for me, that's not particularly overwhelmingly positive. Overwhelmingly positive would be the S&P at 7,200 right now, blowing past the October high. We're not there yet. We could eventually get there, but I'm not seeing that evidence on the chart yet either. There you go. That's my comment there. Couple quick comments here before we get to the remainder of the questions. Three things I want to share with you. Number one, actually two things. Number one, we had our webcast last week. That's not true. It was this week. Boy, this has been a lot this week. It was on Wednesday of this week. We had our last webcast for 2025 called Winners, Losers, and Lessons, your year-end investment review. You can access that replay through year-end at marketmisbehavior.com/lessons. I go through 10 questions that I answer, and I share with you the 10 questions, and I answer each of them as a way of just showing you how I think a very valuable process of reflection and review at year-end can be transformative. I've done this every year for a number of years. It has helped me so much just make gradual and meaningful improvement in my own decision-making process over the years. I would encourage you to take advantage of that. I know the holidays are busy. You probably have a lot going on. Carve out some time between now and the first trading day of January to reflect a little bit. I don't think you'll be disappointed. You can access that replay for free at marketmisbehavior.com lessons. I hope you will take time to review that. Also, we did our 2025 review and 2026 market outlook on Stock Charts TV. I sat down with Grayson Rose in the Stock Chart studio earlier this week. We talked a lot about the different phases of market activity in 2025, some of the takeaways, what was easy, what was not so easy, just what we learned from a challenging year like 2025, and then starting to think about 2026. We talked about seasonality, talked about trends, talked about leadership. That was a really good discussion, I think. We talked a lot about process and routines, but especially about market conditions. You can find that on the Stock Charts TV YouTube channel. I'll put links to both of those here in this video, so you can access those easily. But I hope you'll check those out. Good, timely things to watch right about now. All right, next question. Oh man, I love this one. The Lennar chart, LEM. It's a home builder. The Lennar chart you showed near the end of a video that I did recently could be used to make a case against chart reading. How would you defend chart reading when it can lead to this sort of result? And you had a lot more comments in here. There was a classical breakout in August with strong confirmation. Let me bring up the chart so we can see what we're talking about here. There's a classical breakout in August, with strong confirmation. That was followed by a bull flag. Yeah, maybe this you're talking about, the bull flag pattern. And an additional breakout. But then the chart turned around. Anyone who entered after that second breakout was smoked. How would you defend chart reading when it can lead to this sort of result? Quite easily, I will tell you, it doesn't work all the time. And I will tell you, and again, I appreciate you asking the question. I appreciate the questioning of tools and techniques that we use. I don't have a problem with that at all. These things don't work at all. And anyone in any sort of financial analysis discipline, whether that's looking at earnings or valuations, whether that's looking at PEG ratio or price to cash flow, whether that's looking at quantitative models or technical indicators or anything, nothing works all the time. And anyone that implies that something that they're using works all the time is lying to you. They're lying to themselves, or probably a mix of both. I think some people believe probably very deeply that whatever they're using is the thing to use and that it works pretty much all the time. And they'll highlight examples of where it works all the time. Back in the day, and I won't say who, I used to travel around and do seminars with someone who would hate to show examples of where the tools we were talking about didn't work because they didn't want to imply that it was fallible. They wanted to imply that it always worked. And my answer was, listen, people are using this stuff in real life. They know it. They're going to know it doesn't work because it just doesn't work sometimes. So show them what happens when it doesn't work. So I don't try to, sugarcoat the fact that nothing I'm going to show you is going to work 100% of the time. It just doesn't. I wish it did because that would be super easy. And then we just wouldn't have to worry that much. This would be a very easy game. Money management, in my opinion, is not about being right all the time, right? Because you're not going to be. It's about recognizing when you're right and staying right as long as possible. It's recognizing when you're wrong and staying wrong for as little as possible. And so it's not about just picking the right entry point. It's having a good money management strategy so that you optimize your exit points as well. So the chart of Lennar, I think, looked very constructive, looked fantastic in August. I remember talking about this chart back here as it broke out. When it broke above the 200-day, I remember being really excited about that. When it pulled back and then kind of broke out yet again, like right here, it felt like, all right, this is a recover, breaking above 130. This is the beginning of the new leg higher. Neither of those entry points were particularly valuable. It didn't work. So this was an example of a chart where buying the breakout wasn't enough. And that's why I tell people, just identifying the signal, right? Identifying the buy signal isn't the whole point. In my technical analysis checklist, there are 7 items. The first 6 deal with defining the trend, identifying the opportunity, validating with different technical approaches. The 7th question is, what's your exit strategy? And I always tell people that's the most important question. What would I see on this chart that would tell me I was wrong? So on this kind of chart, right, when a Justin Mamus, famous stock strategist and broker back in the day, would say, when a stock doesn't do what you expect it to do, sell it, right? His whole point was, you're buying a particular signal, you're buying a particular configuration. If that works, great. If it doesn't work, something else is going on. Get out of the position, find a different position, try again. So I would say, yeah, these are a series of failed breakouts. And again, The downside of buying breakouts is they don't always work. The good side about buying breakouts is when they work and when you stick with them, they're fantastically profitable. So this is an example. Yeah, I think you defend chart reading as you would defend any financial analysis on the planet. It all has this issue, which is it's not right 100% of the time. Some of them are right more than others, but none of them are perfectly accurately, perfectly consistently correct. So it's not about being right. It's about recognizing when you're wrong, admitting when you're wrong, admitting when the signal didn't work. That's not a failure. That's a successful test of your money management strategy. Get out of the way and move on. So Lennar is a failed breakout at this point, bouncing lower today. By the way, it's called a hammer candle. So it suggests the next 1 to 3 bars, maybe going into the Christmas session next week. We get a bit of a short-term bounce higher. This is as it's testing long-term support from April, May, June. So something to watch. Thanks for asking that question. And I appreciate it very much. All right, next one. Value over growth has been trending positively for quite some time. However, how do we know that we might prefer value stocks over just going to cash? Yeah, you had, I summarized your question. You said value stocks could be just less ugly than growth stocks, but yet still ugly. So your point was, growth versus value. If value's outperforming growth, but they both stink, do I want to own value, right? Maybe I just don't want to be in there. Totally fair. So what you have to remember, like when I'm showing a chart of growth versus value, this is a chart I was just actually finishing an article. I had to stop writing the article to do the show. I'm going to finish it up for stock charts here momentarily. But the article I'm writing, this is one of the charts I'm going to feature, just talking about the change in character over different periods. And the pure growth to pure value ETFs, the value version has been outperforming the growth version since the end of July, pretty consistently. So what that means is that value is outperforming growth. But does that mean that value is going up and growth is going down? It does not, right? In this environment, right? April, May, June, July, August, we know that the S&P 500 was going up. But just because this ratio is going up, that has no bearing on what the S&P or the NASDAQ are actually doing. The S&P could be trending lower and this line could be going up because it just means growth is going down a lot less than value. So ratio charts, right? Relative performance charts are not absolute. It's relative to one another, which is why I don't think you can look just at this kind of chart, a ratio chart, looking at one thing versus something else, and then draw a complete picture of what makes sense from a technical perspective and whether it deserves a spot in your portfolio. I don't think you can answer that question fully. I think this gives you part of it, which is why it's pretty far down the list of charts that I look at every morning, because this is something I want to understand, but only after I understand the direction of the market, the direction of just different sectors and themes. This is just one of the ways to think about where the opportunities might be. So that's one way to think about it. The other thing is, even if people are really bearish, most investors still have at least some exposure to equities. Very few financial advisors would tell you just sell all your stocks. They would sell, usually think about getting more defensive, right? Within an equity allocation. Maybe you're underweight. Maybe you have less equities than normal, but you probably still have some stocks in your portfolio. So this is answering the question. All right, I know I'm going to have some allocation to equities. Where should that be? And this is something that, having worked with a lot of financial advisors, RIAs, registered investment advisors, it's helping them think along these lines, right? Thinking in terms of allocation and recognizing out of all the ways we could be allocating our portfolio, when should we be leaning more into growth versus value, more into stocks versus bonds, more into commodities versus crypto? And these sort of ratio charts help you make that comparative analysis between two different asset classes and think about where you may want to tilt your allocation. So that's how I would think of something like growth versus value. It's not absolute. And the right answer for you at some point, maybe neither growth nor value, something completely different. That's why this is not the whole picture. This is part of the picture. But I think this comparative analysis is an important area of the technical analysis toolkit that I think gets less appreciation than it deserves from individual investors. Institutional investors, sort of sophisticated advisors, recognize the importance of allocations and rotations and thinking about how you're tilting your portfolio. Individual investors tend to think a little more in absolute terms and just think, do I want to own this stock or not? There's a balance between those two. And I hope discussion of these kind of charts help you think about that. Next question, what are your thoughts about Nvidia's chart? Could it be setting up a head and shoulders top? All right, without looking at it, I don't think so. But I see what you're looking at. All right, Is this a head and shoulders top? I would say no. But let's talk about why. Let's talk about what makes a head and shoulders top. Boy, well, that's not a great way of looking. This isn't bad, right? So here's the last year and a half on Nvidia. We had this big run from the April low up here to an August peak. Then we made this other surge up to a late October peak, and now we're kind of back here. So this all of a sudden looks toppy. And when people say a chart looks toppy, that's because they're seeing something over here. They're seeing a big peak and then some stuff and then some other stuff, and it's starting to look very toppy because we've seen that head and shoulders pattern so often, right? A head and shoulders pattern just means we've made a peak and now we're making lower highs, right? And so it looks like a head and shoulders top. That's what we've been trained to think. So is this a head and shoulders pattern? I mean, it isn't a head and shoulders pattern in that it's not really completely formed. Could it eventually be some sort of head and shoulders kind of thing? It could. I would say the closest this could be what's called a complex head and shoulders pattern, because you have a head and then like multiple left shoulders, and then you may have multiple right shoulders, right? So one thing to think about is if this would be like any kind of head and shoulders or complex head and shoulders pattern. One of the things that's important with that pattern is asymmetry. If the left and right halves of that pattern look very different, I would say it's not a head and shoulders pattern. It's something else. And a lot of times other things can look like it because our brains kind of are hardwired. We tend to see more patterns than are actually there. So I will tell you, if you don't have a lot of discipline to chart patterns, you will find chart patterns that you will say like, this is a head and shoulders bottom. Like it's not, right? It's just, it's not, because the left and right shoulders are very different. The whole thing's sloping downwards, but you'll look at this and say, oh yeah, it's an inverted head and shoulders, because you'll make up some reasons, because we are really good as human beings at finding patterns. And I think that comes from survival instincts and looking for patterns, looking for movement, looking for things. Like we are really good at detecting patterns in relationships because it helps us interact with and make sense of a very complex and confusing world, which is why our eyes are evolved to detect patterns. It can give us some trouble in investing if we see patterns that aren't really patterns, right? And so that's why I would say I would encourage you to really think about the structure of a pattern. Think about the rules that define a pattern, and don't just think kind of is good enough. Close enough is not good enough. You really want to make sure it's a little more structured. And I think the symmetry is one easy way to differentiate a poorly formed pattern to a more consistent pattern, right? The structure matters. So if we would have further evolution and the time and pattern on the left matches the time and pattern on the right, yes, I could say that might be a valid head and shoulders top, complex head and shoulders top. Now, even if it isn't, there's a clear trend line you can draw from the September low to the November low to the December low. And I would say breaking below that would not be good. I would say breaking below 170 would be a pretty valid breakdown, because at the very least, it would then continue the pattern of lower highs and then make a lower low. So breaking below 170 would certainly, for me, validate the fact that we're in a new downtrend phase for Nvidia, because we've broken below the 50-day. We've now traded up to the 50-day. Now we're pulling back a little bit. But until we break below there, it's kind of still just chopping around, more neutral than anything. Nvidia is also in that moving average limbo between the 50 and 200-day moving averages. So one of the easy ways to think about that particular pattern is think of the stoplight technique, right? Above 185 is kind of green light, because we're breaking back above resistance, making a higher high. Anything below 157 would be pretty bearish, because we're breaking below the 200-day. Anything between those moving averages is a yellow light, kind of neutral. Think about that as a way to structure your interpretation of that chart. All right, last question, and then we're done for the show. I would argue top 5 best questions of the year, hands down. I got this on our YouTube channel. I want to salute whoever popped this in there. I read this and I'm just like, what's the chicken money bag? And then I got to flow and I'm like, what's the chicken money flow? Ingenious use of emojis there. Kudos to you, my friend. That's well done. That very clever. I appreciate it. What's the chicken money flow saying? Let's go there. So what's a good play? Oh yeah. Let's see. It's in here somewhere. Chicken volume and shake. Here we go. Chaikin money flow is, I mean, honestly, it's about as neutral as I think you could get. Today, with the bounce higher that we had on decent volume, right? Thursday and Friday have had some decent volume. They were both up closes, but Friday in particular moved the Chaikin money flow, I mean, almost exactly at the zero. I mean, it's 0.002. Like that's about as exactly zero as I think you could get or reasonably expect to get. So what's happened is through the course of the week, the Chaikin money flow finally turned negative for the first time since the end of October. Those last couple times we've dipped negative have ended up being decent bounces higher once the Chaikin money flow got back above the zero level. I mean, it technically did it today, but I mean, just by a narrow rounding error. So I would say going into next week, we'll see if the volume is constructive. And if so, then the Chaikin money flow is not negative. Again, the Chaikin money flow is a way of looking at volume, in this case for the last month, and just looking at signs of accumulation versus distribution. And it calculates that by weighting the daily volume readings by the directional move, where we closed relative to the range every trading day. And so this nice up day we had on Friday on decent volume implies some accumulation going into the weekend that basically alleviates the negative volume picture that we saw kind of Wednesday, Thursday. Good way to finish the week. Again, Friday's bounce on decent volumes, not a bad thing. So setting us up for decent optimism, I would say, in the short term going into next week. Folks, that'll do it. Those were awesome questions. Thank you guys so much, as always, for dropping questions here on our YouTube channel. Please keep them coming, and I appreciate you doing so. Also, to let you know, this is our last show for 2025. We're going to be taking the next 2 weeks off. We will still be putting content on our YouTube channel. We will still be shooting out a newsletter, and I will definitely be sharing thoughts and ideas with my premium members, but I'm lightening up the daily work to focus more on time with family, appropriate attention to holiday related things, and taking some big steps back to just think about my business and think about the show and thinking about all the other things that I like to do at year end to be renewed and recharged for an awesome new year. I thank you so much for watching the show. If it at some point along the way has helped you make a little better decision, has helped improve your market awareness, has helped you just feel better about a very confusing 2025, I'm thankful for that. I will look forward to navigating these markets with you in 2026. But in the meantime, I wish you a restful, joyful, peaceful holiday wherever you're at. For Market Misbehavior, I'm Dave Keller, reminding you, as always, it's always a good time to own good charts. Take care, folks. We'll see you in January.